If you're waiting for a massive housing crash or a face-melting bull run, neither is coming, at least according to Oxford Economics' September 2025 Canada Housing Quarterly Chart Book, that we are heading for a no bust, no boom cycle, meaning nominal prices will dip, then eventually grind higher. Real prices, adjusted for inflation, will be flat until 2030. Today, I'm going to walk you through the charts that matter from their chart book: Toronto, Vancouver, affordability, rentals, mortgages, so that you can position for 2026. Oxford calls it prices slide a bit, then recover modestly. But after inflation, real prices are basically flat through 2030. This is the definition of a long, boring plateau in the housing market, and a housing market that's really only pulled up over time by inflation. There's not going to be any price gains outside of nominal prices. So the idea that your housing asset will actually outpace inflation, outgrow inflation, or serve as a hedge against inflation, people with that expectation might end up disappointed. So while their nominal house price edges up after a dip, real house prices basically stay roughly sideways for over a decade from here. And the big question here is, why won't we see a boom or a bust? There are two forces. Number one is the floor under prices. We have a chronic undersupply, according to Oxford Economics here, especially of ground-oriented homes. But there's also a ceiling on supply because we have more multi-unit supply coming on the market, muted investor demand, and very stretched price to income ratios. And you'll notice how today's price to income is higher than the 1990s, even though unemployment then was worse. There are downside scenarios here. Global trade war or a financial market correction could push prices lower than their base case. And from my perspective, both of those seem like pretty likely outcomes over the next little while. Base case is flat-ish, can still drag us down. In the 90s, we had lots of completed unabsorbed units, and that's what broke the market. Today, unabsorbed units are rising quickly, but from a low base, and we have a structural shortage overall. And so the downward pressure may not be as substantial as it was during the 1990s, but it could get there if we see basically none of the supply under construction get absorbed. You will see a piling up of inventory over the next couple of years. And the recovery actually really depends on how long it takes that inventory to clear. Two Bank of Canada 25 basis point cuts pull people off the sidelines this fall, according to Oxford's outlook. But listings will continue to rise faster than sales, so prices keep edging down into early 2026. The bottom forms early next year, according to Oxford. Then activity improves through 26 as affordability marginally improves, trade uncertainty fades, and jobs inch back. I'm expecting the bottom to probably take place late 26, early 27. So they might be a little bit early on this one, but time will tell. Now, even though they see a bottom in early 2026, they don't see the prior house price peak reclaimed until the early 2030s. And this is really in line with, and it's actually 2033 that they have on the chart here. And this is really in line with that growth recovery scenario that we saw during the 1990s. It took 12 years to get back to the 1989 peak. From 1989 until 2002, they're expecting what looks like a comparable peak to peak recovery, basically 11 years from our 2022 peak. 2025 housing starts looked okay because of projects already in the pipeline, but late 25 and 26 soften, which means higher unemployment, high costs, weaker demographics, slower investor sales, and this huge GTA condo presale drag. Developers are shelving new launches until absorption improves. We just saw Mattamy cancel a project, and the only people who are able to move units are people who are cutting their prices drastically. I think 2 Green Park projects cut like 40% below the previous launch. That's where the market clearing price is. And if the builders who are willing to meet the market there are still moving units. Over the medium term, Build Canada Homes and a potentially revived MERB help would be nudging supply upward and affordability back toward long run ranges. And that's when people can afford houses again. That's when we sort of get back to they're able to buy and lease more of them. And that means that they're eventually we'll see volume recovery. Toronto and Vancouver remain the drag on Canadian housing. Sales ticked up from ultra low levels, but listings also rose, keeping conditions soft. GTA condos have fallen 20% from the early 2022 peak and about 6.5% since late 2024. Investor appetite is obviously still muted for this type of product. And Toronto and Vancouver are still buyers markets. Calgary and Halifax have been a little bit more resilient, although Calgary does seem to be rolling over now. And I would suspect that as we get into more recession territory, it'll be a similar story for markets like Halifax. Most metros are expected to see near-term declines in the second half of this year, but by early 2026, only about a quarter of the cities that they're analyzing or forecasting for here are still falling. So by the second half of 2026, they are expecting prices to go up, and you start seeing positive growth returning to the market, but very slowly. And I would agree with their recovery scenario. I do think that the next recovery is going to be a very slow one, but I'm not sure the timing of it from their perspective. I would say, just for safety's sake, I'm probably going to anticipate that it's going to be the second half of next year where we'll start to see the bottom forming, and then recovery not until 27. And they actually have Calgary as the market that will see the greatest growth in their forecast, with Calgary, Montreal, and Halifax leading, and then Toronto and Vancouver lagging behind. Especially notable here is their forecast for Toronto. Nowhere on their forecast does Toronto actually beat its 22 peak. So and this is where I think a lot of people who are more bearish and are going to listen to my video and think that I'm talking about house prices getting back to their nominal peak, I'm talking about Toronto. But if you look at this chart, you can see that you have your 22 peak here, you have the drop, and then Toronto is basically expected to grind sideways down quite a bit further and start recovery, but not get even close to their 2022 peak anytime within this chart, which goes to about 2030 or 2028. Vancouver, they're expecting to break even to 22 by the 2028 outlook. Halifax and Montreal are expected to be posting profits, as well as Calgary. On the housing affordability side, affordability improved over the last 2 years on lower prices, lower rates, and looser guidelines, but we're still stretched, especially in Ontario and BC Metro. The housing affordability index peaked near 130 in mid-2023 and improved to 104 in Q2 of 2025. But 100 means the median household income can just afford the average home with 20% down. At 104, the average home is still 4% above what the median buyer can borrow. So here's the catch. As prices bottom and fixed rates nudge up, which is their forecast, even with a lower policy rates, affordability gains stall. And this is where it could be a really slow recovery for Canada's market. The housing affordability index worsens towards the 113 mark later this decade, then drifts back towards the 90 to 110 affordable band long term. And Toronto and Vancouver are expected to remain severely unaffordable even then. Average price sits above the affordable band in most big metros in Canada, with Calgary being sort of firmly in the middle of the affordable range, and then Edmonton and Winnipeg really being your only extremely affordable large metro. Sales have climbed for 5 straight months into August, but they're still 8% below the 5-year average. Sales to new listings ratio and months of inventory are balanced but tightening slightly. Balanced overall, but regional bifurcation persists. Oxford expects more listings than demand this fall, and my Toronto Real Estate Board update just went through that, how that's already happening. Prices need to fall a bit more to clear the market in Toronto and Vancouver. If prices come down, more buyers can buy, and then the market can recover on a volume basis, which we're starting to see happen. It'll continue that grind down until there's enough buyers who can afford to buy to push the market back up. And as a result, the benchmark price is still trending down and will continue to trend down. Housing starts are up 4% year over year, buoyed by Calgary, Edmonton, Montreal, and a lot of smaller markets. Toronto, especially condos, has been the weak link here, but the strength in the prairies has really offset GTA's condo weakness. Near-term job losses, shrinking population inflows, high costs, softer rents, weaker investor sentiment. These are all going to suppress new starts. You don't have people lining up to buy these pre-cons or invest in these pre-cons through CMHC MLI Select as the rental housing trade weakens a little bit. So pay attention to the unabsorbed multiples. They're rising and will continue to rise as record units under construction complete into tepid demand. And Oxford puts a great chart on this out, showing your completed and unabsorbed dwelling unit. The pipeline will hit the market. Absorption is really the swing factor. That's what's going to change the market. And as it stands right now, demand isn't outpacing supply in most markets in Canada. So we will continue to trend more in market that's in favor of buyers, which means more in a market where we will see downward price discovery rather than upward price discovery. Medium term, Oxford expects starts to recover in 2027 as policy support, normalized costs, and resumed demographic demand kick in. But they aren't expecting a huge uptick in housing requirements like we saw during the pandemic. So the idea that population growth will become so substantial that we'll end up in that excess demand scenario that we were in before, which was a complete mess, pretty unlikely from their perspective. The gap narrows, but it doesn't vanish here. Now, rents stabilized month to month, but are down 2.3% year over year nationally in August, back to mid 2023 levels. And reason is because rental supply is surging. We've delivered 55,000 purpose-built rentals January to August 2025, up 35% versus the 21 to 23 average. And there's a record number of rentals under construction. At the same time, immigration is slowed, easing demand. Short-term renters are going to gain leverage. Medium-term purpose-built rental apartment pipeline will slow as rents soften, but policy like adding the MERB layer that Carney has promised will keep rentals favored over condos. And I've mentioned this many times on the channel, we're going to continue to see a shift away from condos, more into rentals on the developer side of things. And condo rents are especially more under pressure in core investor markets. Now, the next piece is one of the most important for people investing who think that rate cuts are going to be bullish. And it talks about how fixed rates might rise even as the Bank of Canada cuts. Yes, the Bank of Canada cut in September, but Oxford sees another 25 basis points in October, then a hold around 2.25% through 2026. Variable rates will track down quickly, but fixed are about the bond market, and the term premium could push GOC yields higher, nudging 5-year conventional rates from 5.1% to 5.4% by Q4 2026. So policy down doesn't necessarily mean that fixed rates are going to come down. Now, we know based on a couple of other videos that I've done, and just intuition would tell you this, that arrears rise with unemployment, but they expect them to stay contained. And it looks like they expect unemployment to peak basically middle to end of 2026. Median loan to income is climbing again, especially for first-time buyers, but the share above 450% is still low, which means that vulnerability of new buyers being vulnerable in the market is rising a little bit, but not getting out of control by any means. So what are you going to do with this information here? Number one, expect long, dull sideways in real terms. Focus on cash flow, discipline capital expenditures, and basis. Buy distress in oversupplied subsegments like eventually downtown investor heavy condos where you're starting to see some fire sales, you're starting to see some discounts. If you can underwrite today's rents and stress test fixed rates at 5.5 to 6%. For end users, if the math works at today's rates and your horizon is 7 to 10 years, you're fine. Just don't pay tomorrow's price today. Really focus on capitalizing the fact that we're in a buyer's market. Get those discounts. Try and buy the bottom price today. Again, as I always say, the bottom isn't timable because you have to create it. And all of those lowball offers where the sellers have to come down and meet buyers is what creates the bottom. That creates the next comp, which pulls the bottom down. And by the time you can ever see the bottom or possibly time the bottom, it's already in the rearview mirror. And so if you want to get the best deal, you have to be buying on the way down and be the one pulling the market down. For developers, preserve liquidity, watch absorption and unabsorbed multiples. Purpose-built rental, where it pencils, is going to keep getting built rather than condos because pre-sales are so weak. And so all in all, this is the no drama housing cycle review from Oxford Economics. They expect prices to drift down, then eventually grind up. Affordability will stall. Rentals will continue to gain leverage over condos, and fixed rates might actually tick higher even as the Bank of Canada cuts. If you want me to break out your city's affordability or run rent versus buy on a specific listing, head over to valery.ca and ask Valerie. The calculator and all of the data is baked in. And as always, if you found this remotely valuable, please consider watching another video, liking this video, subscribing, or commenting. I always appreciate the comments. I always try and respond to every single one of them. And thank you so much for taking the time out of your day to watch this. It really means a lot to me, and I'll see you again as soon as I can.